Bank of England's proposed stablecoin ownership limits are unworkable, says Crypto Group. Industry leaders told the Financial Times the plan would be hard to enforce, risk driving business abroad and mark Britain as tougher than the US or EU. The Financial Times FT reported on Monday that cryptocurrency groups are urging the Bank of England, BO, to scrap proposals limiting the amount of stablecoins individuals and businesses can own. The group warned that the rules would leave the UK with stricter oversight than the US or the European Union EU. According to the FT, BO officials plan to impose caps of £10,000 to £20,000, $13,600 to $27,200 for individuals and about £10 million, $13.6 million for businesses on all systemic stablecoins, defined as tokens already widely used for payments in the UK or expected to be in the future. The central bank has argued the restrictions are needed to prevent outflows of deposits from banks that could weaken credit provision and financial stability. The FT cited Sasha Mills, the BO's executive director for financial market infrastructure, as saying the limits would mitigate risks from sudden deposit withdrawals and the scaling of new systemic payment systems. However, industry executives told the FT the plan is unworkable. Tom Duff-Gordon, Coinbase vice president of international policy, said, imposing caps on stablecoins is bad for UK savers, bad for the city and bad for sterling, adding that no other major jurisdiction has imposed such limits. Simon Jennings of the UK Cryptoasset Business Council said enforcement would be nearly impossible without new systems such as digital IDs. Riccardo Tortorerici of the Payments Association told the FT that limits make no sense, because there are no caps on cash or bank accounts. The U.S. enacted the Genius Act in July, which establishes a federal framework for payment stablecoins. The law sets licensing, reserve, and redemption standards for issuers, with no caps on individual holdings. The European Union has also moved ahead with its markets in crypto assets regulation, MiCA, which is now fully in effect across the bloc. Stablecoin-specific rules for asset-referenced and e-money tokens took effect on June 30, 2024, followed by broader provisions for crypto assets and service providers on December 30, 2024. Like the U.S. approach, MiCA does not cap holdings, instead focusing on reserves, governance, and oversight by national regulators.